To understand the concept of tax sparing, one must first understand how a double tax treaty works. In short, a double tax treaty is entered into between states with the intention of avoiding the double taxation of income generated by a corporate or individual taxpayer based in one treaty country from activities occurring in the other. If, for example, the corporate tax rate on income under US law is 35%, while the rate in the UK is 25%, and if a double tax treaty exists between the two countries, then income generated in the UK would be taxed under US law at only 10% on account of the 25% already levied under UK law. To state this a little more accurately, the 35% tax due under US law on the global income of the corporation is reduced by the 25% tax already paid in the UK, so that only a net 10% tax remains due. Put another way, the multinational has been granted a full quote-unquote tax credit under US law on account of the tax it has paid on its UK income to the UK government. It is important to understand that a tax credit resulting from payment of a foreign income tax may sometimes be applied against a domestic tax due on other sources of income. The rules here are extremely complex, but for maximum simplicity, we assume this is always the case. Tax sparing arises when one country, country A, wishing to encourage its residents to invest in the economy of another country, country B, normally a lower income country, allows the taxpayer a full tax credit under its tax law, even though country B has not, in fact, collected any tax on the income in question, for example, due to a tax holiday. The law of country A would stipulate, for example, that a tax credit of 20% under country A's law is allowed on income generated in country B, whether or not any tax has actually been collected by country B. If the taxpayer generates $100 in country B and is otherwise subject to a 35% tax at home, the $100 of income would in effect be taxed at 15% only on account of the tax-sparing arrangement. The activities subject to tax sparing can range widely from the sale of goods or the provision of services to a simple investment in the debt or equity securities of the country granting the tax holiday or of its private sector. In this latter case, the eligible investments are sometimes restricted to ones denominated in the currency of the country in question, sometimes not. We note finally that the United States does not allow tax-sparing arrangements, but several major European jurisdictions continue to do so. It should be obvious that the benefit to an investor from a tax-sparing arrangement can be considerable. Assuming a coupon on an investment of 8%, a tax credit in the home country for 20% of the coupon, and a home country income tax rate of 35%, the after-tax yield of the investment, assuming no tax sparing is in place, would be 8% times 1 minus 35%, which comes to 5.2%. While with tax sparing in place, and the effective tax paid dropping to only 15% of the coupon, the after-tax return to the investor increases to 6.8%, as you can see. Put another way, the 6.8% after-tax yield is equivalent on a pre-tax basis to a 10.46% pre-tax coupon for an investor in a 35% tax bracket. This is calculated simply in this way. It should also be obvious that the benefits of tax sparing are therefore most acute in the case of investments with high nominal coupons, such as emerging market sovereign or corporate bonds, including ones denominated in high-interest local currencies. For investors already eager to take exposure to these bonds, the value of the tax shield makes the investment decision even more compelling. Investors with more limited appetite for the sovereign, credit, or currency risk, however, have attempted to preserve the benefits of tax sparing by investing in these bonds while separately hedging, typically through derivatives, the risks that they do not want. We illustrate this first for a US dollar denominated investment in which the foreign investor hedges away the default risk of the underlying instrument, and second for a local currency investment in which the foreign investor hedges away the currency risk. For our first illustration, we make the following assumptions, most of which are for illustrative purposes and do not necessarily reflect reality. 1. Italy and Brazil have a double tax treaty in place, and Italy allows tax sparing on investments made by domestic taxpayers in Brazilian securities. 2. The normal tax rate on interest income in Italy is 40% versus 20% in Brazil. 3. A tax holiday in Brazil exempts foreign investors from the 20% tax on interest. 4. The US dollar funding rate for an Italian bank is swaps flat, assumed to be 4% for all maturities. 5. Premier Brazilian issuers can issue 5-year US dollar debt at swaps plus 4%, i.e. at 8%. 6. The 5-year CDS for those premier Brazilian issuers is trading at 400 basis points. Those familiar with CDS basis trading will recognize this as an example of a zero CDS bond basis, since the spread over LIBOR of the bond equals exactly the CDS spread. And 7. The 5-year CDS permits the protection buyer to put the bond to the protection seller at par if a credit event occurs. Credit event is defined to include bankruptcy, failure to pay, convertibility and transferability restrictions in Brazil, restructuring of the issuer's debt, and the announcement of a moratorium or debt repudiation. Absent tax sparing, an Italian bank that finds the Brazilian bond attractive could fund itself in US dollars at 4% and invest in the Brazilian bond at 8%, capturing a 4% interest margin but exposing itself to the risk of default. Hedging the default risk by purchasing via a CDS credit protection would eliminate completely its interest margin. The zero return in the hedge scenario should not be surprising, since the investor is taking virtually zero risk and is financing 100% of the purchase price. The tax statements of the investor would show 8% of interest income offset by 4% of interest expense and an additional 4% of hedging expense, bringing taxable income under Italian tax law to zero as well. The tax holiday in Brazil means that no tax would be paid in Brazil either on account of coupons collected. So the transaction will turn out completely income and cash flow neutral for the investor. In the presence of tax sparing, however, the result is quite different. Again, the tax holiday in Brazil would exempt the coupon entirely from Brazilian tax. But from the Italian perspective, the normal 40% tax that would apply to interest collected is now reduced to 20% only, just as if the investor had already paid a 20% tax in Brazil on this coupon. So relative to an investment of $100 in the Brazilian bond, which generates a coupon of $8, a tax liability of $1.6 only would be due under Italian tax law. On the other hand, both the $4 of interest the Italian bank pays on its funding and the additional $4 in CDS premium would entitle it to a tax deduction, whose value to the Italian bank, given the 40% domestic tax rate, sometimes referred to as the tax shield as you may know, would come to $3.2. Offsetting the tax liability of $1.6 against the tax shield of $3.2 leaves the Italian investor with a $1.6 tax shield that it can apply against other sources of taxable income. We can also examine the tax benefits for a taxable Italian investor investing his own funds in the $100 Brazilian bond, i.e. one that is not borrowing those funds in the first place. An example would be an insurance company investing its excess cash. Assuming no tax sparing, the $8 of coupon income would represent taxable income, while the $4 in CDS protection cost would be a tax-deductible expense. There is no tax-deductible interest expense this time, since the investor has not borrowed the funds used to purchase the bond. The investor's net taxable income comes to $4, and after payment of the 40% income tax under Italian law, leaves the investor with a 2.4% return on investment after tax. Note, this is exactly the same result as would be achieved if the investor simply purchased a domestic, risk-free US dollar bond paying a 4% coupon. A result that makes sense, since the purchase of the Brazilian bond with the matching CDS protection essentially creates a risk-free position for the investor. In the presence of tax sparing, however, the $8 coupon would be subjected only to a 20% tax in Italy, creating a tax liability of $1.6 only. The $4 in CDS protection cost would still be a fully tax-deductible expense at the 40% rate, creating a tax shield of $1.6 as well. Offsetting the tax liability against the tax shield leaves the investor with no tax payment due, so essentially earning a 4% return on investment. If instead the investor had simply purchased a domestic risk-free US dollar bond paying a 4% coupon, the 40% Italian tax applicable to the coupon would have left him with only a 2.4% after-tax return on investment. The availability of tax sparing, in essence, has enabled the investor to purchase a risk-free asset and earn the entire 4% return after tax. For our second illustration, we continue with the Italian investor, but this time consider an investment in a one-year deposit in Brazilian reals issued by the Madeira branch of a bank rated AA. The choice of Madeira takes advantage of a tax-sparing arrangement between Italy and Madeira, while avoiding exposure to the credit and sovereign risk of Brazil itself. The assumptions we need for this illustration, in addition to some of the ones already used in the previous illustration, are listed next. 1. Italy and Madeira have a double tax treaty in place, and Italy allows tax sparing on investments made by domestic taxpayers in securities issued by entities located in Madeira. 2. The normal tax rate on interest income in Italy is 40% as before, versus 20% in Madeira. 3. A tax holiday in Madeira exempts foreign investors from the 20% tax on interest. 4. Very high-quality issuers can issue one-year debt in Brazilian reals at 14%. This applies to the Madeira branch of a AA-rated bank issuing in reals. We will consider this 14% to be the risk-free rate in reals. 5. The one-year risk-free rate in euros is 4%. 6. The spot FX rate for euro Brazilian real is 2. And finally 7. Given the spot FX rate of 2, the 4% risk-free rate in euros, and the 14% risk-free rate in reals, the one-year euro-real forward rate would be around 2.1923, reflecting a premium over the spot approximately equal to the 10% interest rate differential, as you know. Consider now an Italian tax-paying investor who purchases a one-year deposit linked to Brazilian reals and issued by the Madeira branch of the AA-rated bank. The purchase price of the deposit is 100 euros, which is equivalent to 200 reals initially. The 14% interest rate under this deposit means that on its redemption date, it pays to the investor an aggregate of 228 reals. To eliminate his exposure to the real currency risk, the investor also enters on day one into a euro-real one-year currency forward with the AA-rated bank promising to deliver 104 euros to the Italian bank in return on the settlement date for delivering to the AA bank 228 Brazilian reals. This reflects a one-year FX forward rate of 2.1923, exactly as calculated previously. The 4% return on the initial investment of 100 euros is what you should have expected, since covered interest arbitrage in effect ensures that an investment in a high-grade security denominated in a foreign currency but hedged back into the domestic currency via forwards must yield approximately the risk-free rate in the domestic currency. The question, of course, is why the investor would bother with all this just to earn the euro risk-free rate. And the answer, you will have begun suspecting, is once again related to tax sparing. Tax sparing once again lies at the root of the structure's benefit in a manner very similar to the previous illustration. The net return of 4% in euros appears at first to offer no advantage over a domestic high-grade investment in that currency. But you need to remember that the actual interest rate paid on the deposit was 14%, which, given the 20% tax rate in Madeira, will generate for the investor a tax credit under Italian law of 2.8% of notional, i.e., of 2.8 euros. Remember that this local tax in fact has not been paid due to the tax holiday in Madeira, but it still generates the tax credit in Italy because of the tax sparing arrangement. When the investor now turns to the calculation of his tax liability under Italian tax law, the inflow under the deposit is combined with the inflow and outflow under the FX forward to give rise to taxable income of 4 euros, as you will recognize. On this, the tax due, if we ignore tax sparing, would be 1.6 euros given the 40% Italian tax rate. But offsetting this tax liability, as with the previous illustration, is the tax credit for the Madeira tax of 2.8 euros. This not only eliminates entirely the tax due on the hedged deposit in Italy, but leaves an unused tax credit of 1.2 euros that can be applied against other tax liabilities that the investor has, shielding another 3 euros. This being calculated as 1.2 divided by 40% of otherwise taxable income from such local tax. This aggregate of 7 untaxed euros can be thought as the pre-tax equivalent return that the investor has been able to earn while continuing to take very little credit and market risk. This, of course, contrasts to the 4% pre-tax rate available on a normal risk-free instrument. We conclude this brief module by discussing potential impediments to replicability. We have used illustrations involving Italian investors because Italy is one country with numerous tax-sparing arrangements with emerging market jurisdictions. But several other countries in Europe, including Austria, Denmark, and the Netherlands, and others elsewhere such as Canada and Australia, have similar arrangements in place as of December 2011, the date on which we are recording this video. And with credit and sovereign bond spreads likely to remain high for some time to come, the attractions of tax sparing on the interest component of a bond investment will remain substantial. That being said, there is growing skepticism as to whether the benefits sought by tax sparing have been achieved, and even the OECD, previously a great fan of tax sparing, has now recommended that tax sparing be granted by its members only to countries whose level of economic development is, quote unquote, considerably lower than their own. Partly because, quote unquote, tax sparing provisions, in their opinion, can provide significant scope for tax planning and tax avoidance, both in the country of the investor and in the country of the investment. The trickier question is whether the removal of a large portion of the investment risks via the CDS in the first illustration, or the FX forward in the second, or any other risk mitigants an investor could use, may be challenged by the domestic tax authorities. Indeed, in the specific case of Italy, we are aware of a recent tax court case in the province of Emilia-Romagna, decided in December 2010, ruling precisely that the tax benefit sought by the Italian investor on Brazilian and UK investments were abusive and should be denied. Links to the court decision in question, unfortunately in Italian, and to an article in English by an Italian tax lawyer summarizing the decision can be found in the course outline appearing at the bottom left of this video. That case involved 3 separate structures, all centering on a sale and repurchase arrangement of fixed income and equity instruments to shift the underlying risk between the parties rather than a CDS or currency forward. So its applicability to the structures we have described may or may not be warranted. The author of the article on these cases explains that, quote, the tax court ruled in favor of the tax administration and denied the tax credits under the general abuse of law doctrine, according to which, when a transaction is entered into, A, without a valid economic reason, and B, for the sole purposes of obtaining an abusive tax advantage, quote unquote, it can be ignored for tax purposes. The author continues by pointing out that, quote, the tax court clarified that it applied a restrictive version of the abuse of law doctrine, which requires that the tax advantage be considered abusive, meaning that it is obtained clearly moving against the spirit, the rationale, and the purposes of the tax provisions from which it is derived. The mere tax advantage of a specific transaction is not sufficient for this purpose. So, as usual, we are left a little uncertain how a precedent like this would apply to a different but somewhat related structure. And specifically, we are uncertain as to what amount of non-tax justification for the transaction would be necessary to overcome the court's ability to deem the transaction abusive. And of course, we cannot opine at all on the extent to which this Italian regional precedent might sway courts in other jurisdictions. What we can do here is to alert you to this possibility and urge early consultation with qualified tax specialists. But for now, we bring this short module on tax sparring to its conclusion.